Good morning. I'll start. Fine, thank you. Today we are going to start about this what we need, that is features of your common stock. What are the basic features of common stocks? How we are going to evaluating the common stocks? How approaches of common stocks? How a bond yields, different types of bonds, bond yields. What are the methods to be implemented for the evaluation of bonds, price earnings, multiplier ratios? All these things we are going to learn. So we'll start with the common stock. So what is the meaning of this common stock? It is an authorized official documents which is going to confirm the ownerships in an organization. So here, when investor is investing in common stock, is very much useful source for the investors who will wish to acquire a capital gains rather than that of a current incomes. So that's the reason this common stocks is going to act as a powerful to the entire stock market. Any person before investing in common stocks initially need to analyze their capability of resisting the risk, because if a person is able to bear a high risk, then returns could be high, and if his risk is low, then the returns is also be low. So that's the reasons he has to take a risk, means he must be capable of resistant particular risk. So what are the features of this common stock? The first features is a real owners, residual owners, voting, appointment, proxy fight, board, reducing agency problem, primitive rights, par value, and a classified common stock. These are the 10 important features of your common stock. Definitely expected question as a theory part. So the real owners of any company are the stockholders of the common stock. So these stocks acts as a security of the ownership in a company. These we called as a real owners, who are going to be real owner of the stockholders, who will be act as a security of the ownership of the company. Residual owners, these are the shareholders who are usually termed as a residual shareholders on the assets and the income of the funds. Why? Because common stockholders, they are going to earn in the form of dividends, and they will receive until the board of directors declared. Even if a firm goes into a liquidation or common stock, they are going to acquire ownerships on the firm's assets only after making the payment to the bondholders, creditors, and preferred stockholders from the funds. If the funds are not available, then the organization need not make any kind of a payments to the stockholders. Next, voting. Shareholders who possess a right to vote in the firm annual general meeting on a specific matter that has been discussed in the annual general meeting. So, shareholders is going to have a right to vote at AGM. Every year they will be having this AGM, that is annual general meeting. They are going to be utilize their voting right. Appointment. Shareholders of the common stocks, these people are going to appointed from board of directors of the company through the voting which has been conducted through this voting process. Proxy fight. Whenever shareholders are unable to attend the meeting to vote, then another person can vote on behalf of him. This process we usually call as a proxy. Board, these are the people who does not meet frequently. Instead of, they will appoint a manager to look after the organization on the daily basis. So this ownership is under the shareholders only. Next, reducing agencies problem. So as we know, the borders are not going to meet regularly. They will meet the managers. So even though ownership is held by the stock shareholders, through a common stock managers process complete control, this could create some kind of agencies problem, such as approximate steps which have been taken in order to solve these kind of a agencies problem. Primitive rights. These are the rights which enables the stockholders to safeguard their proportion of ownership share that were held by them earlier in order to carry forward the same proportion of the subscription by a new share. If a firm wishes to increase its capital, then it has the options of selling the shares. First, it gives importance of existing shareholders, then which we called as a rights offering. Interested shareholders are going to purchase the new shares, and if the existing shareholders are not interested, then they can sell their ratio of the shares to the people who are wishing to buy, that is, shares which are not yet been subscribed by the existing shareholders. They are going to issue in a public. Par value. At the time of issuing shares to the investor, company creates an approximation value of the particular group of shares. This notional value we are allotted to a particular share is called as a par value. The last feature is a common stock classified. This common stock has been classified into two types, that is class A and class B. Under class A, these are the stocks which is going to offer to the publics, whereas class B is issued to the management. Stock of Class A are going to offer the dividend to the public, but they do not possess any kind of voting rights. On the other hand, Class B, they are going to render to the management and they have a right to vote, but they are not going to liable to receive any kind of a dividend. However, if the value of their shares are growing, then they will receive the profit automatically. Okay. So, what is the main scope and importance of this common stock? Valuation of common stocks is completely depend upon the decisions making of an investor of the company. They take number of decisions in the process of investment and they have to decide what to buy, when to buy, how to buy, and all those things. So these common stocks, bonds, real estate, these are all the considered as examples in this common stock. If the common stocks is chosen by the investor, then they has to decide which company stock he has to buy. The common stocks are generally selected on the basis of the risk and return. The analysis of risk and returns of the holding of a particular common stocks is known as a equity evaluation. So the scope, what is the scope of this is we are going to learn investment analysis. Generally, they are going to operating in different organizations need to implement equity valuation techniques to solve any kind of a particular problem. Especially valuation model and the concept which are used by the analysts in order to take decisions related to the various factors. So here, these are some of the what is it important factors which is going to be evaluated for understanding the scope significance means. First is your selecting stock. The basic purpose of equity valuation techniques is to stock selection. Equity analysis need to continuously focus on whether the client should purchase, sell, or own any kind of a security. So the analysis must determine securities as fairly valued. Overvalued and undervalued related to market price of comparable securities are not at all entertained. Next, evaluating business strategies and models. Companies which are interested in increasing shareholders' values should evaluate the effect of alternative strategies on the share value. Rendering fairness option. Merging parts requires fair relating to mergers from third party like investments, banks, valuation plays the valuation plays an important role in such type of opinions. Communicating with analysis and shareholders. Valuation concepts is going to help to communicate and discuss with the company management, shareholders, and analysts on corporate issues. They are going to influence this company's values. Next, appraising private business. Valuation tools are also useful for valuing common stock of private companies. So, as the stock of these private companies are not traded publicly, it is not at all possible to compare an estimate of the stock's values with the market price. Evaluating corporate events. Valuating tools Evaluating of tools are used by investment bankers, corporate analysts, and investment analysts to evaluate the effect of corporate events like mergers, acquisition, diversification, spin-off, etc., etc. These events influence the company's futures, cash flows, as well as the value of the equity. So here, these are some of the things, factors, important factors, which is going to highlight the significance and importance of the valuation of common stock. Moreover, this can be considered as a scope of valuation of the common stock. What are the different methods or approaches of the equity valuation? How we are going to evaluate these approaches? For your information sake, I'll just give the what he said, a pic to share in the group, ma? No problem. Okay, I'll share in the group. So the approaches of these valuation of equity or common stock is classified into four types. That is balance sheet model, discount cash flow model, earning capitalization model, relative valuation model. Balance sheet models includes book value, liquidation value, replacement. Discounted will be include dividend capitalization or discount model, free cash flow method. Earning capitalization, Gordon model, Walton model, price earning applied. Relative valuation, price earning, price book, and price sales ratio. Sorry, ma. So we'll discuss step by step first balance sheet method models. This balance sheet method is one of the approach used in the evaluation of common stock. This model enables the investors about the true financial position of the company. This model can be better understood with the help of a components or measures. The components of the balance sheets are complete pictures of the company. It is going to show the complete pictures of the companies. It is an appropriate way of managing and summarizing the assets and liabilities in the firms as a differential amount between at a given point of time. The diagrammatic representation of the balance sheet is going to help in identify the corporate finance as well as the components of the things. So it includes the assets, liabilities, net working capital. Assets, these are the properties of the companies. They can categorize into four. That is current and fixed assets. And assets with long life is called as a fixed assets. Fixed assets are further we are dividing into a tangible and intangible assets like the trademarks, goodwill, patents, with all the things coming under this thing. While on the other side, the assets we can call as a whose life period is less than 1 year period of time, that is called as your current assets, which is easily convertible into a cash. Liabilities, the firm's ability liabilities are basically we are dividing into a long term, short term. So here how we are having a similar current assets, the same thing we are having current liabilities whose life is also less than 1 year period of time, which are able to pay within a period of time, 1 year period of time. And we are referring before the long term liabilities. So if you are going to consider for the current liabilities, we can call as an account payable, which we are going to pay for the firms which are owned to the suppliers. Long-term liability are the debt which is not due to a coming year, that is from firm would going to support to the later in the coming 5 years. So usually the long-term and long-term creditors are referred to as the bond holders of the firms. So the difference between these two assets values, both the current and fixed assets, are the values of the liabilities. Is called as a shareholders equity, or else we call it common equity or owners equity. So this implies that if a firm is going to sell off all its assets and make use of the whole money for paying off the firm's debts, then the residual value which is left over would belongs to the shareholders. That's the reason the total of those liabilities and the shareholders is always equivalent to the value of the assets. Next method, next component is net working capital. Net working capital is the difference between the current assets and the current liabilities. When the current assets are more than the liabilities, then it is results to a positive net working capital and vice versa. So depend upon the meaning of the current asset and current liability, excuse me, it can be understood that the amount which is available. So mostly 12 months will be more than amount which is paid over during the same period. So therefore, firm with sound financial positions usually holds a positive net working capital. So now we are coming into the exact content, that is what are the methods and models will be there for measuring the balance sheet. In order to handle on some valuation measures, analysts always to have a look at the balance sheet of a company. So here some of the methods which is there for these method is your book value, liquidation and replacement. First one, book value. Balance sheet is used for computing the book value of the assets while preparing the balance sheet. Convention of conservatism is going to follow. And according to these conventions, current assets will be recorded either at their cost or at their market price. So whichever is less, they are going to consider that one. So this convention of last are there. The convention of conservatism is suitable for only for maintaining the records of current assets and it is not applied for the fixed assets. So the value of these current assets, sorry, value of this current assets will be getting with the help of the formula by deducting the depreciation from their cost. So this is going to decline the period of time. So book value of the shares we are going to derive with the help of the formula that is called shareholders equity divided by number of equity shareholders outstanding. Next, liquidation value. One more method, liquidation value. If the organization has decided to wind off its operation, then it will sell off its assets. The value at which the assets are sold in case of termination of business is known as liquidation of value. Though liquidation value seems more realistic compared to the book value, there are two problems which is going to occur in this while we are applying this. The first, it is not that much easy to evaluate what amounts will realize from the liquidation of various assets. Liquidation values does not show the earnings capacity. The last, replacement cost. When replacement cost of such as minus liabilities in another balance sheet measures considered by various analysis while evaluating the company performance. So the application of this measure is on the assumption basis that the market value of the firms must not vary too much from its replacement cost, either other side of the competitive pressures which is going to align the things. Dividend capitalization, so that is called as a discounted cash flow methods. Under discounted cash flow methods, we are having a two types, that is dividend discount model and free cash flow model. Dividend discount model are also called as a dividend capitalization model. So under these methods, the payment of equity share are always issued in the form of a dividends, usually called as equity shareholders, which is going to issued in the form of a dividends and declared as a company by the company that they are the shareholders of the company. As equity is a perpetual security with no maturity date, the dividend payments are made periodically throughout its infinite life. So the interesting value of the share is represented by the with the help of the some formula. So what is the formula? I'll share. P naught is equal to D1 plus 1 plus K to the power of 1 up to T. D is dividends payment. E is K is equity capital. P naught is present value of the share. So here the value of an asset is the present value of all the cash flows of investors which is going to expect from the assets. This approach is known as a dividend capitalization model or capitalization of income method. So the intrinsic value of the equity shares is always depend upon the dividends declared by the company. These models can be are been broadly classified into the some other, that is single period, two stage, multiple. Single period, first I'll give the formulas now. Then afterwards I'll explain so that it will be easy for you people. I'll share this in the group now. So first is single period valuation methods. Under this method, entirely based upon the dividends which are paid on annual basis, and first dividends is going to receive after 1 year period of time, and resale of these things is going to occur at the end of the year. So here, for example, if the investor wants to expect some hold any kind of equity shares for 1 period of time, then the price of the equity shares will be held using with the help of the formula. This formula I am going to share. That formula is P naught is equal to D1 into divided by 1 plus KE to the power of 1 plus P1 divided by 1 plus K to the power of 1. Only for 1 year period of time. So that's the reason only one they are going to pay. The present value of the share we are indicating with P naught. D1 is the dividends after 1 year. P1 is the price at the of 1 year. K is the cost of equity or the required rate of return in the same. Two-stage model. If investor would like to invest for more than 1 year period, then that will be come under your two-stage model. So formula I have shared with you. Formula for this P naught is equal to summation T is equal to I d T into 1 plus G1 to the power of T divided by 1 plus K to the power of T plus Dn 1 plus Gt divided by Ke minus G2 into 1 plus K to the power of N. So here Dn is called as a dividend per shares at the time of second period. When you are going to have a second period, that is first stage model to the second stage model. Second stage model Dn will not consider. G1 is the initial stage growth rate, G2 is the longer growth rate, and N is the number of years when the G1 is going to exist. This is the formula for the two-stage model. Multiple growth stage models, when dividends of the valuation of one dividend growth models which can be mostly used to value the stakes So here in this model, dividends tends to grow different growth rates, which is going to relate to the different time period. So here investor needs to estimate or forecast the dividend rate at the time of future behind the time constant. So definitely he's going to evaluate how it is going to be coming, how the rate of dividend will be there in the coming days. He's want to forecast all those things. So dt minus plus 1 is equal to dt 1 plus g plus 2 plus 3, like that up to we are going to. Why? Because it is a multiple stage, like that they can be evaluated. Next, constant growth model. When the dividend payment increases d1, d2 or d3, so on, then the price of the share under this model can be evaluated. So the best constant model growth model, d1 divided by 1 plus k to the power of g, that is the formula for the constant growth model. Okay. Here some problems are there. I'll share in the group also. Okay. I'll explain this problem. The latest dividends which is going to pay for the equity shareholders is rupees 2.34, and these dividends are expected to grow 8% per every year till the next 4 years, and beyond that till the infinity it is going to be have. The rate of growth rate to individuals will be 4% per year. If the required rate of return is 9%, what is the intrinsic value of the share? So given information is there. With that information, we have been applying into dt divided by 1 plus kg to the power of n 1 plus r to the power of 4. Why? Because it is there for the 4 years period of time. When you are going to apply these things in the values, we are going to get the intrinsic value will be 42.45. I will share the notes in the group so you can go through with that notes. So here, whenever we are having a present value at 9%, which has been taken for the present table values, that is PV factors, and expected present dividends of the first 4 year is rupees 9.16. And for the 4 years period of time, we have been evaluating. So when we are going to apply all these values in the formula, we are going to get 42.45 is the present value of the share. Similarly, Mr. Kishore, who has bought some stocks he has paid for this rupees 3 as a dividend during the last year, and he's going to expect two situation, either 5% decline in the dividends or 5% growth in the dividends in the next year. So he's expecting a rate of return of 20%. With this, we have to evaluate the value of the stock for both the situation. So information they have given: D naught 3 years, GN 5 years, that is 5%. Cost of is 20%. So we know the formula for the 5 years period of time, 5% we have to evaluate. D naught into 1 plus GN divided by K minus G. D naught we have no 3, 1 plus 0.05, that is growth initial start rate, cost of equity minus growth rate. When we are applying all these things in the formula, we got 11.4 is the value of the stocks which has been declined by the 5%. Similarly, increased by the 5%. Same formula we are going to apply. Here we are going to do the summation. So when we have summation, we got value of the stocks which has been grown by 5% is 21. This is a small variation will be there in the when the dividends are been declined and when the dividends are in a normal. Okay. Next, the latest dividends which have been paid on equity shareholders is rupees 3.45 per share. And these dividends have been growing at a constant rate of 6.7% per annum and are likely to grow at this stage till a long discount future. The required rate of return is 11.2%, and we have to find out its intrinsic value, whatever the things which is said today, for the period of 2 years and after 5 years also. So information, the dividends, they have given 3.45, required rate of return that is K 11.212, growth 6.7. So we are applying in the formulas, we'll get all these things. Similarly, how we have been done in the previous problem, the same things we are going to learn. Next, free cash flow method. This method is deal with evaluation of firm's value of equity with the help of the discounting factors. So here the investors must multiply with the discounting factors and obtain the value deducted from the value of the preference as well as dividends. So the procedure for this free cash flow is that first step divide the future into a two periods, that is split the forecast period and the balance sheet. When the duration of the explicit forecast periods ranges from 5 to 15 years, which represent the period within the firms is experienced to evolve and grow. So far, to reach the stable level, the stability of the firm is characterized by the certain things. Next, forecasting the free cash flow. When free cash flow is called as a net cash flows, which is available to the firms for distributing them into the capital providers. So we can call this free cash flow with the names of net investment, NOPAT, changes in net fixed assets, changes in the net working capital. After second step, then we have to compute the, that is weighted average cost of capital in the third step. Then afterwards, we are going to establish the fourth step by establishing the origin value of the firm. Origin value of the firm. One minute now. Next, establishing the origin value of the firms. When we are evaluating the set of firms, assets need to add them the expected value of the shares, that is n number of years, which is usually termed as the terms value, that is origin values, with the help of the FCS, which is considered the constant growth rate of G. So after that, you have to evaluate the enterprise values, which is called as a firm's values with a combination of present value of FCF during the equity forecast of the period. Next, derive the equity values. So we are going to evaluate the equity value by deducting the preference values minus debt values. After that, we are going to determine the value of the ET equity shares, that is equity shares divided by number of outstanding of the ET shares. So this is the procedure for free cash flow method. The next method is your earnings capitalization methods. Earnings capitalization mostly include with the Gordon's and Walter and per price earning ratios. Gordon model, we all know Gordon model. Gordon model was developed by the Madden Gordon, and this model believes that dividends are relevant and dividend has an impact on the firm's value. So he is going to support Walters in the analysis of relationship between the dividend policies and the valuation of the shares. Certain assumptions will be followed for the Gordon's models. It is first one, it is assumed that the firms in all equity firms and all investments are financed through the retained earnings. It is also assumed that the perpetual life of there has no corporate taxes. The cost of capital is constant and more than growth rate will be there. The internal rate of returns remains will be the same, and firms decided a retention ratio and it remains a constant. Certain implication is also follows for the Gordon. When internal rate of return exceeds the cost of capital, then price of the share increases and the dividend payout ratio decreases. Similarly, when the internal rate of return is same as the cost of capital, then dividend policy is not increased by the price earning and share will be remains constant. Share will be remains constant. When internal rate of return, when internal rate of return is less than the cost of capital, then it leads to the increase in both the price of the share as well as the dividend payout ratio. Limitations of the Gordon model. This model is purely quantitative and it does not have considered qualitative factors such as the industry trends and trends in management strategies. This model is highly sensitive to inputs having an impact on the growth rate. And if it is not used properly, then may generate misleading and irrational results. So due to the fact that the value of the dividends may becomes infinity when the growth rate coverages on the discount rate. This model is mostly suitable only when the growth rate is constant, and if growth rate exceeds, then the required rate of return of the Gordon models may not be suitable for the determination of value of the dividends. So here are the calculations in this model. The calculation is entirely based on the assumption that future dividends will grow at the constant rate forever. This model not at all suitable for the rapid growing industries, which is less than predictable dividend. As it is a case of the Gordon models, we are having a formula for the Gordon model, that is P naught is equal to into 1 minus E into 1 minus B divided by KE minus BR. This is the formula for the Gordon model. I'll just okay. Next, Walter model. Walter models believes that the dividends are relevant because dividends influence the value of the firms. According to Walters, firms cannot be isolated from these dividend policies because they are associated with each other. So here, the Walter is supported by the important statement of three existing relationship between the internal rate of return and the cost of capital, which influence the optimal dividend policy of firm. When internal rate of return is more than the cost of capital, then the firms must preserve its earnings. And when internal rate of returns is less than the cost of capital, then the firms must distribute its earnings to the shareholders as dividends. In the same situation, when R is greater than K, the optional payoff ratio will be zeros, which results in increasing the value of the shares. And when R is less than K, then firm distribute all the earnings and the optional payoff to the 100%. So here, the formula for the Walter model, I'll share all the notes, ma, fix notes in the group, ma. Don't worry. D press 1 R divided by K into E minus T divided by K. This is the formula for the Walter models, where P is the market price of the share, D is dividend per share, R is internal rate of return, K is the cost of equal, E is the earnings per share. Okay, this is the formula for the Walter model. What are the assumptions of the Walter models? Walter's models assume that all the investments made by the firms are financed through the retained earnings and not from any kind of external source of funds like debt or any kind of equity. It is assumed that the business risk of the firms does not change, which implies the internal rate of returns and the cost of capitals, which remains constant. And firm is going to concern with the perpetual life and the value, which is determined earnings and dividends with all at the time of the entering into the things only. Criticism. So in Walter models, all investments have been financed through the retained earnings, which is possible only in all time of equity firms. And the cost of capital remains constant is not acceptable since the pattern of financing changes of the capitals also changes. The internal rate of returns remains constant and is not possible in real world. When the investments of the firms increases, internal rate also is going to have a change in the market. Next method is the price earning ratio approach, called as a PE approach also. Price earning multiplier approach is also known as price earning ratio, which is used to estimate the value of the stocks by the investors rather than adopting the discounting model. Every financial magazines and the newspapers at regular intervals is going to purchase these price earning ratio approach. Certain advantages will be there for this price earning ratio approach. It indicates a price per rupee. It indicates a price per rupee of the shares. This would be help to compare the prices of stocks and helps in analysis of the stocks companies that will not pay any kind of dividends, but rather than of having earnings. It should be noted that whenever there is any loss, the price earning analysis is also difficult to use. The variables which is used under PE ratio models are easier to estimate than the variables used in any kind of discounted models. And we know the formula for the ratio is P naught is equal to E1 into 1 minus B by KE minus T. Next is the price book value of the ratio, that is P by BV ratio. This is the book value of the each equity shares to that of a net asset value of the company, that is assets and liabilities, which are been divided by the number of equity issues which is of the equity shares. So accounting conventions and economic events which are being used for the assertion of the book values. Here market price of the share is ascertained by the manners in which market is going to evaluate its earnings price. So investors is usually get the attractive by PV ratio. So here this is has been issued in the greatly contributions to the returns for the stocks. So the determinants of these PV ratios can be clearly understanding with the help of the formula, that is G1 divided by R minus G. So here the price sales ratio, that's P by S ratios. So with the help of this P by BV ratios, which is going to indicate that the higher ROE leads to the increase in the PV ratio. So here when it is indicating the higher results, then there is an increase in the PVV ratio indirectly. Price sales ratio, that is P by S ratios. So here this price ratio has been gained much importance as a valuation of the techniques. This ratios is generally computed by dividing the company's current stock price by its revenue per share and the last 3 years. If it is also going to be computed by dividing the present market value of the shares in the last years, the value of the firms, basically the price earning ratio indicates the market willingness as to pay in exchange of 1 rupee of sales. So here some of the investors who's going to be face some kind of a problems with this approach is highly inconsistent earnings, negative earnings. Earnings may be explained in various ways, possibility of managed earnings. Yeah, but in order to remove any kind or reduce such type of a problems, this ratio must be used continuously. So here, certain types of tools will be there, that is book value, return on equity, P ratio, yield, P ratios, etc., which is going to suggest and recommend all the investment tools. And it also has been considered as one of the most useful tool. This is because the portfolio of the low PS ratio stocks are more effective than the portfolio of high PS ratio stocks. So according to this, a famous thumb rule we call as the standard of PS ratio, that is 1.0, can be used by all the companies. The stocks which is traded at PS ratios and which are less than 1. Here, the example 0.5 are considered as a bargains. PS ratio is not same for all the industry. It is basically referred from one industry to another industry firms because the factors like profit margin, growth rate, assets turnover, etc., are not same for all the things. They are vary from one firms to another firms. So that's the reason is the techniques of relative valuations and it's being interpreted in terms of the drivers. One of the key drivers of this is the net profit margins, which implies that the PE ratio is considered as a PE ratio, net profit margin ratio approach. This is about your price of sales value approach. Next, security market indexes, that is CAPM. Capital assets pricing models, which is going to help to measure or evaluate the relationship between the expected rate of returns, and it is a expected rate of security, which is going positively linear functions of the sensitivity to change its market portfolio. The relative frequency of this is individual and a systematic risk because a non-market risk is eliminated by the diversification. The formula will be used for this RF plus beta into RM minus RF. The most preferable formula for the CAPM returns, and the definite expected question is the assumptions of CAPMs. So investors evaluate the portfolio by looking at the expected returns and standard deviation of the portfolio over a number of period of time. So investors are never satisfied. So when they will give a choice between the two otherwise identical portfolio, they will choose only one of them, therefore higher expected ratios. So investors who are being risk averse, then they will give a choice between two otherwise identical portfolios. They will not choose with the one layered standard deviations. So individuals mostly prefer the assets are indefinite individuals. That means an investor can buy a fraction of shares if they are desired. And there is a risk-free rate at which investors may either lend, invest money, or borrow any kind of thing. So taxations, transaction costs are entirely irrelevant under the CAPM assumptions. And all the investors is having the same period of origins. Risk-free return is will be same for all the investors. Information is freely and instantly available to all the investors. So here these are the certain things, certain advantages and limitations also we are going to know. Advantages, it is help in evaluating the portfolio performance as well as the cost of equity, risk and assess the risk and helps in determining the relationship between the risk and expected returns. It is a future-oriented model that it helps in predicting the future returns of the securities. It is also used even the dividend information is not provided. Historical data for calculating the betas, which may not be direct, the risk associated, will be analyzed with the help of these CAPM. And certain limitations are there. As it is a single period value due to these discount rates, which is calculated with the help of CAPM, may not give any kind of appropriate result. An unsystematic risk gets diversified because of CAPM as its own systematic risk. CAPM will be always deals with the single figure that is beta, and it's closely similarity of activities and business risks which may arise as difficult in comparing the proxy. So we are having a certain problems for the CAPM. I'll share one problem. Okay. Mm. So formula RF plus beta into RM minus RF. So here certain is stock information will be given, and the returns will be given. Expected betas is also will be given. So based upon the betas and the returns, we are going to apply in the formulas RF plus beta into RM minus RF. So we will going to apply simply very easy things which is easily available and easily can be solved. Next, SML, that is security market line. It provides a relation between the expected returns and the standard deviation of a given market portfolio. So the security market lines will be indicated with RF plus beta into RM minus RF. And these are the things which is going to help for over and under price of the securities. So it is provides a benchmark to identify whether the securities are fairly priced or not. The securities that are plotted on the SMLs are said to be fairly priced, and which are remain securities, they are divided from the SML. So overpriced securities are those whose expected returns is less than or equilibrium returns. These securities have a negative value of alpha. Underpriced securities are those who are expecting returns is more than or equal returns. They have been positive alpha. Underpriced yields are more returns expected than the plot about the security market lines. So here underwriters are the persons who is going to sell those strictly at the higher prices than the fixed rate, which is lead to decrease in demand. Investor who does not want to invest in their money in securities because of overpricing the company issuing the security will suffer. Okay, this is about your ML and APT, arbitrage pricing model. The last concept, arbitrage pricing theories. It is an alternative methods of asset pricing which have been developed by the Stephen Rufus, is known as APT. According to this, the returns of the securities which are mostly influenced by the number of macro factors like the growth rate, industrial productions, inflation rate, spread, long-term and short-term interest rates. So here, this is also called a law of one price. That is, the law which states that the two identical goods should be sell at the same price. If they are sold at different prices, anyone could be engaged in arbitrage by simultaneously buying at low price or selling at high price that make a riskless profits. So it applies at the financial assets. When two financial assets have the same risk, they should have the same expected return. They do not have a same expected return. The riskless profit should be earned by the simultaneous listings. So arbitrage pricing models will be there for the classification of two types. That is one risk factor and two risk factor. One risk factor is equivalent to the CAPM. This is equal to the risk-free rate of return. However, the assumptions of this model is differ entirely with the things. So here it will prefer more wealth, less risk, risk averse, homogeneous expectations. Capital markets are perfect. Even though it is perfect, unlike CAPM, it does not assume one period origin, returns are normal distributors, particular type of utility function, market portfolio, investor can borrow or lend at risk-free returns. So this is all about the arbitrage pricing theory for a factor, single factor. Two factors when they will be dealing with the risk associated with the two, beta 1 and beta 2. So this is about your APT and the formula I'll share for the APT. Okay. So this we have completed now. Bonds evaluation of bonds, a small synthesis of CAPM and APT. So equilibrium models, it is CAPM is an equilibrium model, whereas EPTM is also a equilibrium models. And CAPM always assumes a market is efficient and frictions, and APT assumes that market is efficient and frictionless. CAPM is used to assess the theoretical rate of returns, whereas APT is used to for assessing the theoretical rate of return on assets. It helps in determining the expected return of returns as a CAPM case, and APT helps determine the expected rate of returns on the model basis. And it is developed by the Jack Taylor, William Sharps, John Linter, and the John Monoson during the years 1916. APT has been developed by the Stephen Rose in 1976. CAPM is going to take less time to calculate. It takes APT is going to take more time to calculate. CAPM is considered only one beta, one factor calculation. APT is considered the multiple factors calculation. CAPM is less accurate. APT is more accurate. CAPM is based upon the risk rate of return data, and APT is based on the statistical and mathematical return. CAPM is includes the simple data, and APT is going to include several relevant data. CAPM always face a difficulty in determining the good proxy of the market value, whereas APT is going to face difficulty in determining the approximation factors. CAPM is very much simple compared to that of APT, and compared to that of CAPM, APT is very complex. So this is about your synthesis and comparison of your CAPM and APT. I'll share all the notes in the group, ma. You just go through with the notes, problems. In the next class, I'll start the mutual fund. So only one method will be there. How we are going to evaluate the performance of mutual funds. So the performance of mutual funds will be evaluated with the help of three methods, that is SP, TP, JP. Sharps, Jensen's, Trenson's. With these three methods, performance evaluation of mutual funds will be analyzed. Okay. With this, we have done with the today's notes, ma. Today's class. Till now, no one has joined in the class. I don't know why, ma. But I'm sharing the problems, pics, notes, all the things in the group. If it is helpful, well and good. Okay, please go through with the notes. That will be very much helpful to you.